Thanks for joining us on Power Lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Duggal. Let's get to the headlines this Wednesday afternoon. Quiet Wednesday trade on the Indian markets. Nifty trades flat. Banking stocks trade weak.
Punjab National Bank falls over 7% after the public sector lender detects fraudulent transaction worth over 11,400 crore. PTI reports that CBI has received 2 complaints from PNB against a jewelry designer Nirav Modi.
Bloomberg reports that Untitled Cement and a consortium led by Dalmia Bharat are the front runners for Binani Cement. 4 other bidders also in the fray.
US sales are expected to weigh in on Sun Pharma's third quarter numbers, slated to be released today.
All right, all of that coming up along with views on the big banking change that we got on Monday. But before that, let's take a look at how the markets are faring. Neeraj is with us. Neeraj, what's the market looking like?
Well, yet another day of subdued volumes, Ira. The trade is subdued, yes, we all know. I mean, the Nifty Bank is pulling the index lower. And if you just look at the MRR of the Nifty Bank components, you will see that corporate-facing banks and PNB in particular are the ones which are actually pulling the index down and thereby putting that pressure on the index as well. But volumes too in today's session have been unusually low. So 3 days in a row now, we've had turnover which isn't exactly at its peak. We're nowhere close to those, ending the day with the 35,000 to 40,000 crores of the cash turnover on the NSE. Let's see if today is any different. But today might well mark the third day on a trot wherein volumes are very, very iffy. Volatility, again, nothing really to write home about. In terms of gainers, I think NBFCs have done well both on the index and on the larger space. So the likes of Indiabulls Housing Finance, Bajaj Finance, M&M Financial seem to be doing okay. So all of those stocks have had some good gains to themselves. Technology by and large is okay. Reliance, HCL Tech as well as Tech Mahindra amongst others seem to be doing fine for themselves. Wakrangi is off the circuit, off the low circuit for the third day in a row. So 3 days in a trot now. It's back to its winning ways and up about 5%. Be careful though if you're trading this one. But by and large, banks dominating trade. The index is merely supported by what's happening to Reliance Industries individually, IT individually, and Bharti Airtel, which is up about a couple of percentage points. Otherwise, banks essentially the principal drag. And I think Ira in the morning, if you logged on Harsha at 8 a.m., Ira would have given a fabulous reason as to why banks are going to be the newsmakers of the session today.
But is that the view on banks, that this is going to weigh on NPAs, provisions? Is that the market view?
So I think brokerages have taken that view that any kind of impact, positive or negative, will come in after 2 or 3 quarters. And I think it tied in with what Sanjeev Sanyal was telling us as well, but it probably somewhere down the line. Corporate-facing banks, almost everybody off reports on dealer checks are saying that corporate-facing banks are something that clients are going slow on right now.
All right, Neeraj, thanks so much. And we'll talk a lot more about that story.
But the big one has to be what Punjab National Bank did. It's detected 11,000 crore fraud. Clearly, we should bring that stock up on the screen to tell you the kind of sort of hit that stock has taken. At opening at about 7.5%, now trading lower about 7%. The fraud, it seems, the transactions occurred on a branch in Mumbai. Other banks may also get drawn into this alleged fraud. Vishwanath Nair now joins us to tell us what we know so far. Vishwanath, why don't you take us through first the modus operandi of what really happened?
So essentially what we understand from our sources, and at this point in time it's all unnamed sources who are talking to us off record, but there was a buyer's credit that was availed on the basis of a letter of understanding that was issued by this particular branch of the Punjab National Bank. So letter of understanding essentially that this client is a solid client, and that in the event of a default or in the event that this person does not pay us back, we will take care of the payment. Essentially it's that, and on the basis of that, some of the international branches of domestic banks, a lot of them, and some international banks have all given loans to this particular buyer. In this case, from what we understand from our sources, this is the Nirav Modi case, which has been in the news for the last week or 10 days or so. Basically, this person availed this company. There are about 3 companies which are under investigation at this point in time. They availed some of this credit, but then the underlying transaction for which the credit was availed did not happen. That is the kind of news that we are getting at this point in time, and this has been confirmed by various sources within the government as well as the Central Bureau of Investigations, who all said that Punjab National Bank has put in a complaint against Nirav Modi and his companies. Mehul Choksi, the MD of Gitanjali Gems, was also allegedly named in these FIRs that the Central Bureau of Investigations has filed. He is trying his level best through his legal counsel to get his name off the FIR. This is something that Gitanjali Gems said in a statement on the stock exchanges last week. So this is where it stands at this point in time. 11,000 crore is a massive number, because when PNB first flagged this off, they said about a 280 crore number. So now that has been revised to 11,000 crores. So that's a massive number. Today there is a meeting that is happening with the domestic bankers, trying to see what impact this could have on Gitanjali Gems' domestic business and potential legal implications of this matter. Gitanjali Gems is a stressed company. It is currently under restructuring at this point in time, and then depending on what happened Monday night with the Reserve Bank's new guidelines, that will also be under discussion by the lenders, plus the legal implications of this case.
Okay. Vishnu, just sequence this for us. I mean, just to reiterate, because we need to understand what PNB has said in its statement. So it has said that there have been fraudulent and unauthorized transactions, and in brackets messages.
Right.
And then based on that, other banks have given advances to overseas parties. Right. So essentially there is some sort of a letter of assurance or something that PNB has, letter of comfort that PNB has given, based on which other banks have given out advances.
That's right. So there are, as I said, international branches of domestic banks as well as some international banks who have all given out loans on the basis of this, and then these things are being verified at this point in time, whether this transaction actually happened or not. So that part of the investigation is still on. PNB says that all of these are only liabilities that it has, contingent liabilities. So only in the event of a default do they need to pay, but it's still there. So it's something.
Have we heard anything at all from the Nirav Modi camp?
Nothing at all. So we have sent out emails, and we have placed calls to the Nirav Modi side of the story, but then they haven't responded to anything so far. But then we'll give them the day to see what they have to say. Okay, big one. It's 11,000 crore alleged fraud. Vishnu, thank you so much for that. The other big development in the banking sector, the Reserve Bank of India has released a new overarching framework for bad loan resolution. The new rules effectively put an end to most of the other stressed asset schemes introduced before India had a bankruptcy code. The rules also put a strict timeline on the resolution process. Now, how does this impact the banking sector? Credit Suisse expects NPAs and provisions to in fact rise. Ira sums up the implications of all of this. Ira.
All right, so these rules came in late evening on Monday, and the general sense among the analyst community was that NPAs will rise, provisions will rise, and you will see an incremental stress on the Indian corporate lenders. Credit Suisse, in a report today, has put it all neatly together and given us some numbers, so we're relying on them for the analysis. But the basic theme of the analysis, that NPAs will rise and provision hit will increase, is the same pretty much across the board, no matter which brokerage house you look at. What CS has done is that they've given you a breakup of the total stress, which is at 16% odd. But within that stress, remember, there is NPAs, there is restructured assets, plus there are assets which are under the SMA2 category, it's called, which is essentially a category of borrowers which are 60 days overdue. There are 3.5% of total advances, which is already under the IBC. This is the 12 large accounts plus the second set of accounts which the RBI had asked banks to refer to the IBC. So that's about 3.5, and they are expect 3.5 lakh crore. I'm sorry, they expect another 1 to 1.5 lakh crore to go into this over the next 6 months or so, as the second list of accounts start to get admitted for insolvency proceedings. Now, other than that, there are NPAs which are about 6.3% of advances. There are also loans which are under various stressed asset schemes, which is about 3.1% of advances, and about 2.5 is under the SMA2 segment. The total adds up to about 16%. Now, what Credit Suisse is suggesting is that over the next few months, you could see the quantum of loans which go into IBC add up to almost 5 lakh crore. That is the amount of money which would then require incremental provisioning as well, because remember, as per current rules, the RBI requires that you provision 50% against the secured amount and 100% against the unsecured amount in cases which have been referred to the IBC. There has been no change in that provisioning requirement, at least specifically laid out in the notification that came out on Monday. So I think the key takeaway on the NPA levels is that you will see NPA levels rise, perhaps closer to the overall stressed asset level. We had spoken to the IBA chief earlier this morning, and he said he doesn't think the NPA levels will rise because he thinks a far stronger effort will be made to come up with a resolution plan within the 180 days provided to banks before they have to take an account to the IBC. Now, that's in terms of the NPA numbers. What is the broader impact? Again, there are a bunch of regulations which have impacts. So one, of course, is that the existing schemes, the STRs, the CDRs, the S4As have all been withdrawn. The resolution plan needs to be approved by 100% of the bankers. The new regulations seem to suggest. These two put together suggest that NPL levels will rise. Also, the resolution plan needs rating approval. Again, if that is tough to get, you will see a higher level of NPLs. The other set of things to focus on from a provisioning standpoint is the fact that an investment grade rating is required for an upgrade. Satisfactory performance has to be put in place until 20% of the loan has been repaid. Credit Suisse says this will also mean slower upgrades of accounts which have been already downgraded into the NPA category. Then you move on to other aspects of the circular, such as the fact that you will see, as we said, more cases going to IBC. Also, any default during the resolution period will mean that you have to refer the account to IBC. All of this will mean higher provisions. So net, as the market is also reflecting, you are likely to see corporate lenders under stress continuing at least for a few months to go. We had a chance to speak with the principal economic advisor Sanjeev Sanyal, and he agreed that there could be some sort of intermittent addition to stress, but he said that overall you will get a far cleaner framework. We'll get you that conversation a little later on in the show. Harsha.
Thanks for that. Well, that's coming up a little later, but let's talk about talking about IBC. Kumar Mangalam Birla and an investor group led by Dalmia Bharat have emerged as the lead bidders for Binani Cement. Bloomberg News' George Smith Alexander is here with some exclusive details on this one. George, what do we know? What's the bidding amount? Who's leading?
So if you look at it, as of on Monday, there was a rebid which has come in. All the 6 bidders who had put in their bids earlier, they came in. They have put in the rebid, but the difference this time around is most of these bids are cash bids. And what we understand is that Ultratech and Dalmia Bharat, which has a partnership with the Bain Piramal Fund, that's the India Research and Fund, these two are the lead bidders. Both of them have bid for around $60 billion rupees. And the difference would essentially be in 2,500 crores of unsecured creditors which they have to, which they would be paying, and also on how much debt and how much equity they will be giving to the lenders.
Do we know if there's anyone else in the fray?
JSW is also a strong bidder. The others apparently are a bit behind, is what we have at least got to understand.
Okay, so this is the same, there were reports about Rakesh Jhunjhunwala being in the run as well, isn't it?
Yeah, so it is Rakesh Jhunjhunwala, Damani, Heidelberg, the host of True North along with Ramco. So yeah, those are the other bidders who are there in the fray.
George, thank you so much for that.
Thanks.
All right, let's move on back to the markets and what's been moving the markets. Neeraj was here giving us a broad overview, but he's picking on one specific segment which has been extremely strong, and that's tyre stocks. Those have been firming their grip over the last few days, with Seat and Apollo Tyres gaining for 4 straight sessions. What's at play here? Neeraj is back with us. Neeraj.
Yeah, thanks, guys. So, yeah, good, not a bad move in today's session considering the markets are very, very flat. But there are some fundamental reasons and some triggers. Actually, almost all the reasons are fundamental reasons. The next set of graphics will show you. It's been steady, actually a very strong quarter and a strong delivery on numbers. But more importantly, strong volume growth posted by almost all of the tire makers post several quarters, to be honest. After a spate of 4 or 5 quarters have we had such strong volume growth, and maybe strong CV demand is driving these volumes as well, because you've heard it in almost all the CV makers that the CV demand is picking up, and that could be really driving the volumes. Now look at the revenue numbers, and you will see that there's a clear distinction of what this quarter has done in terms of revenue growth versus what the last few quarters have done. Yes, for MRF, Q2 was good, but nowhere as good as what Q3 has been. Similarly for CEAT, and the next slide will show you CEAT's total income growth, and look at that. Yes, Q2 was okay, but nowhere close to what Q3 has been. And Apollo Tyres as well, it's been our strongest domestic volume growth in the last several quarters for Apollo Tyres as well. So that's essentially the picture on the volumes and the revenue. Now what's driving these kind of gains? There is a lagged effect of price hike, which is now seemingly showing, and there is talk of some players having hiked prices even as recently as the last 15 days. All the companies, MRF, CEAT, Apollo, they have posted the highest margins in the last 4 quarters in the quarter gone by. And needless to say, there is evidence that there is a margin uptick that would have come in because of the way the rubber prices have behaved, and crude cooling off only aids to the sentiment. Now look at this. I've just chosen Apollo as an example. The others may have a slightly different correlation as well, but this is just depicting the kind of correlation between Brent oil and Apollo Tyres. So with oil moving up, the stock started coming up, and look at this move in the recent past wherein crude cooled off and a sudden spurt that came about in the stock price of Apollo Tyres. Similarly for rubber prices as well, when rubber prices have cooled off, the tire stocks have moved up. And remember, the budget actually helped as well. There was a lot of factors that are at play in terms of help from the government and triggers as well. So there's an anti-dumping duty on Chinese tires. The budget put 15% customs duty on truck and bus radials, and that started moving up as well for the tire companies. So lots of factors at play. Synchronized volume and margin growth recovery will probably only attract newer money to come in. Keep in mind, Harsha and Ira, that the last 6 months, the maximum gain that is coming from a tire company is about 7%. In fact, one of the 3 has actually given negative returns. So people by and large have shied away from this pocket. If the delivery that they have done in Q3 can be continued in Q4 and otherwise, then we can expect more returns from the tire companies.
Neeraj, thank you for that. Well, we are at the fag end of earnings season. The last Nifty company to report earnings numbers today is Sun Pharma. Darshan is standing by with what we can expect from the pharma major. Darshan.
So Harsha, Taro, which is a US subsidiary, has already reported numbers, and that came out with a weak set of numbers. So the expectations are pretty low. Now on a consolidated basis, we are seeing a decline of 12% on the top line. The bottom line will come in much lower. The EBITDA margins we are anticipating close to 22% versus 30% that we saw last time around. Now Taro numbers were extremely disappointing. They are 15% of their total sales, 50% of their US sales. So that will weigh in significantly on the US business. Apart from it, pricing pressure is definitely there. Competition is definitely there, and that will weigh in on the US business. But some positives that will come out is the fact that there was deferment of some of the orders from the second quarter, and that will come into this quarter. Apart from it, it's a strong quarter for the subsidiary DUSA, so that will also help them, and some of re-entry of some of their products from the Halol facility, as well as market share gain in Gleevec is something that could aid the revenues on a quarter-on-quarter basis. But nevertheless, we are seeing a 30 to 35% decline on their US business, and India business growth anywhere in a high double-digit number, given the fact that it was a low base last time around. But expect a slightly weak or a muted quarter from Sun Pharma this time.
All right, thanks so much for that, Darshan. The government is likely to miss its renewable energy target. That's according to a research house. Non-hydro renewable energy capacity will rise only to about 120 gigawatts by 2022. And India is joining us with details on what she picks up and the kind of miss in targets that we're talking about. And India.
Well, this is not the first time that someone has said that India's renewable energy targets are ambitious, but not only is BMI Research in their latest report saying that India is going to miss its 2022 targets of 175 gigawatts and only going to install 120 gigawatts by then, as you said, but they're also saying that by 2027, even 5 years after 2022, India will be able to install only 164 gigawatts as opposed to 175 gigawatts. Now, the reasons that they give for this kind of slow progress on India's targets are the things that plague India's infrastructure sector in general. They are saying that financial and logistical delays are going to slow this down. Also, the grid, India's transmission system, is underdeveloped and also inadequate, and that may also hinder India's renewable targets. Now, this kind of a report is something contradictory to what the Power Minister R.K. Singh has been saying for some months now, that India is going to exceed 175 gigawatts and actually going to install 200 gigawatts by 2022. And they're also saying that about 100 gigawatts of solar and wind tenders would be brought in for auctions over the next 4 years. However, the problem that experts point out with so many tenders coming out is the lack of buyers. There may not be enough procurement or enough power purchase agreements for all this capacity coming over the next 4 years. Now, there is also one catch here, that the BMI report says that 175 gigawatts is also their projections on 175 gigawatts is non-hydro capacity, which is the original government's target of having wind, solar, biomass, etc. Now the government is kind of changing the narrative by saying that hydro projects, big hydro projects, which are about 50 gigawatts, will also be categorized as renewable energy. So obviously, if the category of these projects changes and they also become renewable energy, then the target will get a boost. So back to you.
Anindya, thank you so much for that. Well, coming up next, a conversation with Principal Economic Advisor Sanjeev Sanyal on the implications of the new bad loan resolution framework. That's coming up in a moment from now.
Welcome back. You're watching Power Lunch. Let's take a look at the headlines. It's a quiet Wednesday for the Indian markets. The Nifty trades flat even as banking stocks drop.
Punjab National Bank falls over 7% after it detects fraudulent transactions worth over 11,400 crores. PTI reports that the CBI has received 2 complaints from PNB against designer and jeweler Nirav Modi.
Bloomberg News reports that Ultratech Cement and a consortium led by Dalmia Bharat are the front runners for Binani Cement, 4 others in the fray as well.
Okay, quick check on how the markets are faring right now. It's been a quiet day, as we mentioned. Agam is here with some of the stock movers in the last half hour.
Well, it certainly has been very quiet. It's very evident in the kind of turnovers that we're looking at when it comes to the cash markets as well as the F&O market. So cash in the cash market, that is the NSE cash segment, is where we're looking at turnovers a little over 20,000 crores. And when it comes to the NSE F&O, just short of 4 lakh crores, not too much to speak for, largely in line with the previous 3 to 4 day average. That said, in the broader markets, they continue to outperform. What we've also seen is the mid cap and the small cap indices advanced by a little over 0.7%. Now, when it comes to the banking space, it is the PSU banking sector and the index as well, which is dragging and bearing down on several of these indices. And this is largely on account of the weakness that we've seen in Punjab National Bank as well as Bank of India. The Nifty Realty Index, on the other hand, has been gaining for the 2nd straight day. So we are looking at some gains there. And Nifty essentially has been kept buoyant by Indiabulls Housing Finance and Bajaj Finance. And there is some amount of weakness in the likes of Infratel and Axis Bank, but on the whole, a very quiet session.
All right, Agam, thanks so much for that. Let's move on and talk about what else is happening. We've got a broad picture coming in from Bank of America Merrill Lynch. They put out their survey on what fund managers are thinking. Let's go across to Nikki Meerchandani, who's giving us the key takeaways from the February edition of the survey.
Sure, yeah, it's not an optimistic picture that the BofA ML survey has painted around. It says that the survey was conducted between Feb 2nd to 8 and almost 196 panelists participated with 575 billion AUM. Finding of the survey, respondents indicate that S&P bull market will peak around 3,100 level, and allocation to equities have fallen to 43% from a net 55% overweight, which has been the largest 1 month 1-month fall that we've seen in nearly 2 years. Allocations to bonds have now been at record low of net 69% underweight, and they're sitting at a cash balance which has risen by 4.7 to 4.7% this month, up from nearly 4.4% that we've seen in the month of January. Only 5% of the fund managers say that they expect that the global interest rates will fall, while 80% say that they expect it to rise. A record net of 24% of investors survey says that global corporate balance sheet at this point of time look over leveraged. The key takeaways from this, if we were supposed to summarize in 2 points, it says that the investors are anxious at this point of time, but that does not give a clear call as to they would like to buy on dips, and they have certain amount of cash in hand right now, but then they're not locating that in terms of equity right now.
Nikki, thank you for that. ICICI Prudential Mutual Fund has increased its stake in Power Grid and NTPC, and it's went short on Bharat 22 ETF and ICICI Bank last month. What were the other changes in the key portfolio changes in January? Let's head across to Jayesh Kilnani for some of those details. Jayesh.
Good afternoon, Harsha. So, the startling fact that I actually observed on the portfolio changes is that 62% of ICICI Prudential mutual funds portfolio, that has seen a reduction in the stake in each of the companies that they hold. But let's have a look at where they have increased and decreased their stake. So, in terms of where they have increased, like you were mentioning, Power Grid and NTPC, the two utility players, Yield Place probably they've added about 2.7 crore and 1.7 crore shares respectively. Z Entertainment, they added nearly 1 lakh shares, Ashok Leyland and Union Bank. So, these are the other counters that actually saw the highest increase in stake in the portfolio of ICICI Prudential. In terms of where they have decreased stake, Bharat 22 ETF, now they've sold off as much as 33.8 crore, shares of Bharat, or units rather, of Bharat 22 ETF. ICICI Bank about 2.5 crore shares. ONGC goes down 1.4 crore shares. So does National Aluminium and Axis Bank. So, the private sector banking names appearing in terms of where they have decreased their stake. In terms of where they actually picked up fresh or, sold off completely, let's have a look at those positions as well. So Voltas, they've purchased a fresh at about 7.1 lakh shares. KPIT Technologies, remember mid-cap IT space has been buzzing off late. 4 lakh shares they have added over there. Amber Enterprises, the recent IPO, they picked up about 1.35 lakh shares, and Bank of India as much as 30,000 shares bought fresh over there as well. In terms of where they have sold off completely, you have HT Media, 33 lakh shares that they held, though that goes out completely. So does JSW Energy to the tune of about 32 lakh shares. Clariant Chemicals and Sanofi India also make their way out of the portfolio of ICICI Prudential Mutual Fund.
All right, Jayesh, thanks so much for that. That's one individual fund, but more broadly, Indians have been pouring record amounts of their savings into the stock market rally via these funds, but they may be at risk of getting burned. That's according to the latest data from the Association of Mutual Fund of India. We've got Shantanu Chakrabarti joining us with an analysis that he filed earlier today, which you can also read on BloombergQuint.com. Shantanu, what's the big picture?
The big picture is that there's a lot of balanced funds out there which have been sold over time to retail investors, and the retail investors, the small savers, have got the impression that this is some fixed income instruments. So the risk in the system has increased because of that, because a lot of funds have actually have a bonus dividend option, monthly dividend sort of option, which gives the impression that this is kind of like a debt structure, but which is it not, which has a 65 to 70% equity coverage. So those funds have underperformed the benchmarks this year. Not only that, not only the balanced funds, but the growth funds also have underperformed their respective benchmarks. So that's a situation of concern for investors who are parking their retirement money into the markets.
What are experts that you're speaking to saying in terms of returns from the markets in this year, and second is what should investors be doing?
So investors should actually a lot of mutual fund managers are saying that telling their clients to have moderate return expectations this year, because the returns from equities will not be that huge as in 2017. So they should have some more buffer in terms of having exposure to debt. And in terms of they should reduce their exposure to small and mid-cap stocks and have more exposure to debt. That's what a lot of people we talk to are telling us.
Shantanu, thank you so much for that. That's the bigger picture on what's going on in the markets. But let's get back to the development that's weighing down on banking stocks today. RBI stressed asset resolution framework, Principal Economic Advisor Sanjeev Sanyal quells fears of steeper haircuts and higher number of liquidations. In a conversation earlier today, he said that even though there is a strict timeline in place, there is still enough time to put a resolution plan in place, and that does not necessarily mean more liquidation. Listen into a slice of that conversation.
We had this large number of schemes, processes and so on, which were very, very complicated. So what we have done is we have removed a large number of these and replaced them with what is a generic framework. It's a simple, clear framework, which hopefully everybody can recognize and implement. It's also reasonably flexible. So should there be any reason to change it, it's at least clear what we are changing. You see, the earlier scheme or set of schemes were, there were overlapping procedures, confusing acronyms. So now we have a system that is generic. It's a framework. Of course, more things will be added into it to make it work. But I think all parties know now what the framework itself is. And, we already have further downstream the IBC process. So that has now more or less got going. So the upstream part, which is the recognition of the NPA in the first instance, that has now been given some sort of a clear framework.
Mr. Sanyal, it's flexible, yes, but in some ways it's also fairly prescriptive, isn't it? I mean, they're very strict deadlines, and I'm not saying they're unjustified. We've had a terrible experience of the last few years, so we're probably learning from that. But on banks, it's a fairly sort of strict timeline to put that 180 days, even in cases where you have 20 odd banks involved to come together, everybody agrees on a resolution plan. If not, go straight to IBC. Is that a little tough?
Well, we'll have to see how this goes. Obviously, we don't want various unintended consequences of these things. But, it's 180 days is not a short period of time, 6 months, in which hopefully a resolution plan will be put together. But, one thing is happening is very early on, you're also recognizing this. So earlier the problem was you spent a large amount of time simply recognizing that there was a problem. There was no central repository of knowledge which everybody got informed that there was a problem emerging in a certain entity. So that time has already been, reduced, because now, very, very quickly everybody knows that there is an issue. Now, of course, we need the banks also to respond quickly and come up with a resolution plan. You're raising a valid issue. Otherwise, everything ends up in the NCLT, and the NCLT gets clogged. So the whole process now has to be smoothened out. But yes, I mean, 180 days has been put in place for the time being, and the judgment is that this is a reasonable enough time to come up with a resolution plan. You don't have to implement all of it, by the way. This is just merely to come up with one.
Sure. Mr. Sanyal, on that specific point about reporting default within a week for credits above 5 crore, I believe, do you think the next step to that is to making this CRILC public in some ways, going back to what SEBI had attempted to do, which is, inform the public about defaults in listed companies? Then that was withdrawn because there was some confusion about what default is, although I'm not sure why. But now with this in place, do you think the next logical step is to have that default in public knowledge, sir?
I wouldn't presume to announce a next step. This is what it is as it stands. We will see what happens as a result of it, take feedback and adjust it along the way.
On the issue of what the implications are, Mr. Sanyal, and I'm putting to you what views we've gotten over the last 24 hours or so. One impression is that you will see the reported NPA number rise closer to the overall stressed asset number, particularly as accounts in that 60 to 90-day bucket, we may not be able to get resolved in the remaining time frame. Is that a fair understanding? And B, the understanding is that provisions will most certainly rise even if the first scenario doesn't play out.
Let's see how it goes. I mean, as you know, we have recognized a very large number of NPAs over the last year or two. and various resolution processes have been put in place. Sure, there may be a one-time increase since the recognition process has now been so much sped up and made much more transparent. But by and large, I think things will settle down. It's a much fairer, cleaner system. And as I said, we will see how this plays out and make adjustments if necessary. But frankly, this is, as I said, a transparent system for whatever it's worth. As I said, it's not as if that as soon as you recognize that there is a problem, you suddenly take them straight to liquidation. There is a 180-day process. Then there is a 15-day further for actually, putting it into NCLT. Another 180 days to come up with resolution. A 30-day further extension, and so on. So there is a long way till till some forced resolution happens. Along the way, many forms of recovery, resolution, etc., can be attempted. And really that is the part that now needs to be strengthened.
Mr. Salil, there's also a question, I can't call it a fear, but a question as to what the extent of liquidation would be with, perhaps a larger number of cases going into IBC, and then you start to talk about the implications for, jobs, the economy. Your sense, Mr. Sanyal, on the risk there, I don't know if it's possible to pin it down, but do you see that as a risk?
See, we have gone through that process already last year. I mean, where a large number of cases, very large cases, accounting for 2/3 of the NPAs, were identified by the RBI. First a case, 12 cases, and then another 40 cases. And yes, these kinds of efforts may cause some pain. But I think the one-time adjustment to taking our system to becoming much more modernized, responsive to as information evolves, that the financial system is able to quickly respond to these things. In some cases there may also be liquidation, auction, and so on, but that is not the intention of this. The intention of this is that you quickly recognize that there is a problem and begin to work with the entity to try and resolve it. And as I said, that part has to be strengthened so that, as you correctly pointed out, everything doesn't have to turn up into the IBC. So that is not the intention of this.
What is your estimate of the early experience under the IBC? I know early days yet, but what do you think is, is it flowing as quickly, as smoothly as you thought or hoped it would? There are some challenges in large cases which may delay the timeline, Mr. Sanyal.
Certainly, I mean, it was a completely brand new system. Remember that. So in some ways, we had to learn along the way. But nevertheless, I think the NCLT has worked reasonably well. Even before we end, you actually see the end point of that process. You have seen a major culture change in the corporate sector and in the banking sector. The banks have now become much more serious about recognizing and providing for the NPAs, and similarly, you've seen in the there is a clear recognition in the corporate sector that eternal evergreening is no longer something they can expect, and that resolution of some sort will have to be carried out. You have seen many promoters getting rid of various inefficient investments. Overall, when all of this is happening, it makes the overall economy much more efficient when you carry this out. It also means that prospectively going forward, when investments are made, more thought will be given about the amount of capital being deployed, why it's being deployed, because remember, this capital has other uses as well. So if an inefficient user preempts it, it leads to it basically means that other investments were not made. So, cleaning this up was very, very important. Now, you're absolutely right that, during the transition, some pain does get inflicted on the economy. We saw that in 2017 that, but the economy has now recovered from that. You can see the IIP numbers beginning to come back, and so on. So, we have gone through the transition. We have more than survived it. and in the end of the process, you'll have a much healthier banking system.
Sir, but just the collateral damages. So one point I want to check with you, actually 2 points I want to ask you about. One is that do we risk a scenario where the banking system is very sort of averse to lending to large corporates? And I also point to a reform package which had been announced by the government, which said that you have to limit your exposure to corporate credit at 25%, I think. That put together with the enormous pain that the banking system has gone through on account of corporate credit, do you think we risk a scenario where people just don't want to lend to large investment sort of projects or infrastructure projects?
See, there's always a risk that you will swing from one extreme to the other. So, that is a part of economic management. This is not about the framework, but about managing transitions, managing expectations, managing the work culture. So, yes, it's something that is an ongoing thing, and it needs to be monitored and adjusted to. You cannot, there is no quick formula to this. It's a risk that exists. We are aware of this risk, and we will, have to manage it.
The other point is what came up in the economic survey, slightly more theoretical, is that the recovery in terms of the investment cycle from, a balance sheet driven slowdown could be very, very slow. In India's case, Mr. Sanyal, what is your sense of, how quickly we could recover from this in terms of getting the investment to GDP ratios up, sir?
Well, I'm no longer in the business of forecasting in that sense. The point is that I think the recent numbers have suggested that the economy is recovering. The global economy is also recovering, which also is a good thing, because it means that exports and other things will also hopefully pick up with it. So the idea here is that as the economy adjusts to this new ecosystem of GST, IBC, and so on, that we will now be able to begin growing with the new paradigm in place. The transition from that earlier paradigm to this one obviously led to various friction to the system, but I think now we are in the new paradigm and we have got to make this one work.
One last question, Mr. Sanyal. This sort of new I don't know if it's new, SME lending has existed forever, but this sudden sort of, every statement talking about SME lending, from the government, from the RBI, what's going on here? I understand the need to lend more to SMEs, but there have been other issues there as to, whether these companies have the required paperwork, etc., to be able to, get credit from banks. Do we not again run the risk of pushing too hard on, one particular segment, and it could end up, coming in, it could be the new infrastructure, if I can put it very bluntly, of the next few years?
You see, as you said, the cleanup of the banks disproportionately hurt this segment for a very simple reason. This segment relies almost entirely on the banking system, because they don't have the kind of access to capital markets that larger players have. So in that sense, we do need to handhold them a little bit. And the same thing happened with GST. Unlike the very larger players, they are not in very often not in a position to hire lawyers and accountants and so on to take them through the transition. So some of them did have difficulties. We recognize this. So I think we do need to handhold them a little bit. In the end, the SMEs are a source of resilience to the economy. They're a source of jobs, innovation, and so on. So it is not unfair that we put some special effort looking at their needs.
All right, let's move on now. That was Sanjeev Sanyal, Principal Economic Advisor. Indians, meanwhile, are eating more cheese than ever before, it seems, and dairy companies are boosting their capacity to meet the rising demand. Charlene D'Souza has been speaking to some of the top makers, including Amul and Parag Milk Foods, joins us with a little more details. Charlene, over to you.
the cheese market in India may only be 1% of the total dairy consumption in the country, which is far behind the European Union, which is 36% of their total dairy consumption. However, it is the second fastest growing dairy category in the country, that is right after yogurt. Now, the cheese category, which is a 2,900 crore category, is growing at an annualized growth rate of 13% as Indians are now consuming more protein in their diet, which has caused for the consumption of milk and milk products to increase. Now, Amul is looking to double its capacity over the next 2 years, and in the last 3 years, it already tripled its cheese capacity, while Parag in the last 2 years has increased its capacity by 20 tons per day to 60 tons per day. Now, Parag is also focused on growing this category going ahead, as it is seeing huge demand coming in from the retail consumer. Now, however, the processed cheese category may be growing in double-digit growth rate. The gourmet cheese category is also growing at a very fast pace, and however, this is on a very low base. Now, Dairy Craft, which is a gourmet cheese manufacturer, has said that demand is increasing by 25% year on year, but this demand is largely driven by the institutional segment, that is demand from hotels and from restaurants.
Shalin, thank you so much for that. Out of time on the show. Thank you so much for joining us today.